There are properties that are very, very difficult and you are stuck with very, very high interest rate. Bridging always seems daunting. The numbers involved rate-wise, fee-wise is going to be higher than any other normal mortgage. If someone comes to me and I really don't feel like they're going to be able to kind of go through with what they're saying or their numbers are miles off, if your refurb cost, someone's saying they're going to do extension work and I know that they won't be able to deliver it for that price, then it's my job to probably say no, and the lender will see straight through it anyway and cause problems further on down. The bigger issue we have is if you buy it, people buy them on buy-to-lets, convert them without anyone knowing, you're actually putting yourself in breach of mortgage contract. I think there is a kind of change in landscape in buy-to-let. I think, your single property, buying it. A lot of the time it could be people drawing down on their pensions to buy one buy-to-let to kind of tick them over, that's gone. Not a lot of people feel sorry for landlords. I'm aware of that. I have to be careful what I say there. But at the same time, someone's came to me and they're saying we're going to spend 50,000, but when you get the schedule of works, the surveyor says it's 100. The bank will always trust that surveyor over the client, and that can impact numbers.
Is buy-to-let dead? John, good to have you here.
Thank you.
For this podcast, it'd be good to tell us more about you, to start with, who you are and what you do.
Fine. John Green, Hawk Financial Services. So I've been a mortgage broker as part of 20 years, give or take now. Last 10 years, specialist. So more buy-to-let, commercial, bridging, anything kind of in the middle. So predominantly, more complex the better. Anything slightly out of the ordinary is normally where I will help.
Yeah.
Well, with less. In your case, HMO, among other things.
Yeah. Yes, HMOs, but we started with the flat, the bridge, the famous flat. I still remember I was using another broker, and we bought this flat for £135,000. It was a repossessed property, and we did the works, and it had a short lease, and it was next to the pub.
Yes.
So my old broker couldn't manage to get refinance for that property. So I asked around, can I find a good broker? And somebody suggested your name. Within a week, you managed to find me a lender.
Yes.
For our property. That's how we started. Maybe you can tell a bit more about.
I think anything like that is the more you do in that world. You know what I mean? So I see low leases very often now. They're not rare. If you do, say residential lending, you're not going to see low leases, or not as many of them.
Yeah.
In that instance, the pub's the tricky bit actually. And then there are numerous lenders that will lend at 60% loan to value. I think from memory we were at 75. And then that with the low lease is quite a hard mix. Again, it almost comes down to common sense lending, and there are specialist lenders that will look at that. What is the risk? You know what I mean? And actually, you bought it for so long, the worst case is you could pay to extend the lease.
Exactly.
And then there are, 50, 60% loan to value. So, so there are normally homes for things. There are properties that are very, very difficult and you are stuck with very, very high interest rates. In your case, it wasn't actually crazy. I remember it was pretty much
5.9.
Yeah, run of the mill in that world.
Yeah.
Like I said, I think more it's experience. How many times you see properties in close proximity to commercial, what the commercial is. Pubs are one of the high risk ones, actually. They're not easy. And there are lenders that will lend, if the deal makes sense.
Yeah. Okay, that's good. So that property we got, first we had a bridging loan.
Yeah.
And then we refinanced after 6 months. So for those who don't know much about bridging loan or scared to take bridging loan, can you explain what bridging loan is and how to get one? So on.
Yes. Bridging always seems daunting. The numbers involved rate-wise, fee-wise is going to be higher than any other normal mortgage. But what I normally advise people, it's essentially a cost of doing business. It opens doors that wouldn't normally be available to you. If there's a property there, there's no kitchen, no bathroom, someone may have started already doing a refurb and it's stripped all the way back to brick. Halifax aren't going to lend on that. Santander aren't going to lend on that. Your normal high street entities won't lend. Whereas on a bridging loan, they will. Providing there's a clear plan on the property, a schedule of works is provided, and the numbers all make sense, most will lend. Certainly, in the flat, low lease, similar problems with normal mortgages. But again, when there's the option to extend, as long as we're clear about it, there will be options, simple as. And I think that's the kind of key point. A lot of people will look at properties and be put off by the condition, knowing that finance is hard. But actually, bridging finances can be quite easy. They will essentially lend on nearly anything, but you've got to be prepared to pay the interest rate. Without quoting specifics, you are going to be looking at all in 12% a year, give or take. There's a legal expense in that, as we can discuss later. But you cost that in. If you factor that price into all of your numbers and it still works, then what's the problem? Certainly over recent, say, year, 18 months, where interest rates have been higher, I think the difference between bridging finance and buy-to-let finance actually isn't that big. You're looking at a couple of percent here or there, but obviously there's a huge amount more hoops to jump through on a buy-to-let loan. You're reliant on a rental income. If the property's not even habitable, it won't work. I always say, look, use it as a tool more than anything. Yes, it comes at a price, but it will open doors that you wouldn't have if it wasn't there.
If you're a first-time property developer, can they still get bridging loan?
Yeah. I mean, some lenders say no, they prefer a couple of kind of deals under a belt, but there are numerous lenders that will allow first-time buyers. Again, it kind of comes down to presentation. If you've got someone, and that's more my job, I will suppose. If someone comes to me and I really don't feel like they're going to be able to kind of go through with what they're saying, or their numbers are miles off, if your refurb cost, someone's saying they're going to do extension work and I know that they won't be able to deliver it for that price, then it's my job to probably say no, and the lender will see straight through it anyway and will cause problems further on down the line. But actually, if they come with a solid plan, they've got the money to do it, or, whether that's their own money, parents, whoever it may be working, that's fine. I think the only kind of exception is if they want to live in it. That's the one. That's the main question we get with first-time buyers, depending on what they're buying. Yeah. If there's any chance of them living in it, most banks won't necessarily like it. There are options, but for the most part, that's the biggest hurdle, and it's not massive. We could get there.
Yeah, I always think, even in my case, bridging loan completely changed the whole scenario. Before, I was saving money, buying buy-to-lets, and so on and so on.
Yeah.
Now I call myself a professional developer now, purely because I have access to the tools like bridging loans, which really helps you to scale up your portfolio.
Well, I think the £4, 12% a year for too long really does. There is a kind of general incentive. I imagine in your own mind that actually I don't want to be paying this for long. The quicker I get this done and exit, usually through refinance, the quicker I can then revolve your money and move on to the next one. And bridging is pretty much designed for that. Auction initially was the main one. We use it a lot for auction purchases because of time constraints, can be done very, very quickly. But, in a lot of cases now, it is more refurb projects. Specifically, whether you actually, not always specifically, whether you want to fund it yourself or fund the work, both are options. Either one works. It's definitely got a home at the moment. Arguably, I'd say very, very much of, I don't know percentages, but a large proportion of what I do is now bridging finance, certainly compared to buy-to-let.
Yeah. Oh, wow, really?
Yeah.
We've been doing a lot of HMOs for the last 14 months or so. Again, for those who wants to get into HMOs, how do you get a mortgage for an HMO or portfolio of HMOs? And obviously, you've got small HMOs, 6-bed. And also then you've got large HMOs, which is sui generis.
All the way up. So whatever. Yeah. You can. Starting with a HMO, that's going to be quite daunting. I imagine there are a lot more regulations around what you can do with them, as you know, fire regulations, the room sizes, the other bits and pieces. With a small HMO, providing it's not an area of Article 4, which is normally the first thing to check because otherwise you'll have difficulties.
Sorry, for those who don't know.
Article 4 is a kind of legislation by a lot of the certain London local authorities now that you need full planning permission for any form of HMO, 3 or more people. So, realistically, I'd normally say stay away from those, certainly as a first time, landlord, buyer, whatever it may be. But certainly in other areas where that legislation isn't there, you can buy a normal kind of 3-bed, 4-bed, 2-bed, whatever, how many reception rooms it's got, convert that to a 5 or 6-bed. Pretty straightforward. You need to, like I say, the regulations around it, all mostly fire regs, and your minimum room sizes are there. You can get it done. You can let it out very, very quickly. A lot of lenders prefer you to have experience with HMOs. There's only 1 or 2 that don't. But there's still options. Cap Reliance and others will allow a first-time landlord to be a HMO owner. So they are there. And bridging finance being used for HMO conversion, again, very, very common because it just helps with cash flow. The bigger issue we have is if you buy it, people buy them on buy-to-let, convert them without anyone knowing, you're actually putting yourself in breach of mortgage contracts, which, to be honest, it's not worth the risk. You actually may need that lender on the exit, you know what I mean? So it's almost trying to keep everyone on side. Bridging finance makes sense for that with an exit onto a standard mortgage product or a HMO mortgage product. It does change when you get to 7 beds. I think you've touched upon that. So, to get to the large HMOs, more select group of lenders. And again, really, you do need experience for those. Even the kind of more flexible lenders will want you to have had normally only a year's worth of landlord's experience. Doesn't even have to be on a HMO, will be enough to open doors. And that then opens doors with 7 and 8 beds to different types of valuations, which I'm sure you're going to move on to in a minute. But in principle, it's exactly the same thing. It's a normal mortgage based on the rental received.
Mm-hmm. And if you don't have the experience, can you then maybe do a JV, joint venture with someone who has the experience, and then
tidy it up later, or do it as a long-term JV? Yeah, that's no problems at all.
Yeah. Moving on to that topic, what's the difference between bricks and mortar valuation and versus commercial?
Yeah, I think bricks and mortar is the more traditional one. So if you were going to go and sell your house as a normal 4-bed, 2-reception room house, you'll get what every other 4-bed to. There'll normally be a range based on that pure bricks and mortar valuation. Investment valuations are slightly different because they will assess based on the rental received and therefore yield. So, if you're renting out those 6 bedrooms, they will essentially annualise that amount and give a percentage net yield calculation at the end of that to come up with a value, which we always hope is going to be higher than the bricks and mortar one. And that's the main difference between the small HMOs and the large HMOs. So on a 7-bed, most lenders will now only give a commercial valuation. It's almost deemed a commercial asset just because of the amount of bedrooms it's got, and therefore it gets warranted with a commercial or an investment. They're the same thing, valuation. So whereas, going back to my original point, if you've got a 7 lettable room and it was bricks and mortar, you're going to get essentially a slight uplift on a normal house. You're not going to get anything. If you're getting an asset which is generating 10% yield, you'll get a yield-based percentage, not normally at 10, somewhere around 8 to 9% is normally where, sometimes lower, sometimes higher. It's really very much area dependent. Article 4 does play a part. Who your tenant profile is plays a part. It's almost impossible for me to give a specific number. On average, it's normally between 8 and 9%, and they'll work that out, and that's the valuation that the lender then lends again. So, making the numbers up slightly, if you've got a standard, say, 5-bedroom house with a couple of reception rooms that could be a 7-bed, that might be worth, 600,000. It was let out lower, £800, and you're getting that extra room. It could be 200,000 more than that, just because of the investment valuation behind it. Main reason is if you were going to sell it, who's going to be your buyer? And that's really what it comes down to. It's very rare that a family is going to buy a 7-bed, 7-ensuite house which has been solely designed for students to live in, as an example. Exactly that. Yeah. This is it. So for the most part, people know that when you're designing that property, that's something like what you do from scratch. You've got one design in mind. It's for your end user. That isn't family. So therefore, it is a commercial kind of investment property. Therefore, it should be looked at that way.
Yeah.
That's, there are other complications. We talk about gross yield, net yield, some will deduct.
Yeah. Can you just explain how you roughly get to
that? And that again can vary, so some surveyors will take a set percentage off for utilities if you're paying them and other bits and pieces. So, when you look at that, I always kind of try and just keep it as simple as possible. What you're getting each month, annualise it out. I've got numerous examples where some surveyors will take 20% off of that. Some might take 10. The other popular one is that, you might be getting £1,000 a room, but they think that's too high and they'll bring it in at 900 and then not take as much off. And you kind of always end up roughly in the same spot, hopefully. And so that's pretty much how it's calculated. So it really is area driven as well. I think that's the biggest kind of the point I would make. A lot of people, I'll get calls. My friend's just had this done. He got 7%, so we want to go with them. The same surveyor could go out, but because it isn't in a predominantly student area designed for students, I'll come back at 9%, and they'll be like, why? I can't really give you an answer other than exactly that. That property was in an area where it was perfect, whereas they're basically saying yours could be easily replicated. You could buy one over there. If it's not Article 4, of course, pretty much you can buy any house and turn it into a HMO, provided it's got the space. And that also plays a part. So, it's a contentious point, I think we should say. Sometimes it's I'd always get asked, what do we base it on? And the honest answer is I can't actually give you a black and white answer on that. So we normally aim at 8.5%. Maybe push the boat out a little bit and see if we get any more than that and see what it comes back like. But for the most part, around that area.
So it's annual rent.
Annual rent, basically divided by that kind of 8.5%. And that will give you a kind of ballpark figure of where it comes in.
Obviously, I usually take bridging loan, then potentially private investment or development loan to do the works.
Yeah.
Can you tell me a bit more about how development loan works?
Yes. So development loans, if you've got a home, they are essentially a kind of another drawdown account. So they'll lend you a normal mortgage to buy the property, and there'll be a pre-agreed amount of money to one side, which you can then draw down in stages to assist with the actual build or the development, whatever you're actually doing. Historically, it was 4 drawdowns, but to be honest, there are lenders out that do it in as many or as little as you want, but it's always done in arrears. So, let's keep the numbers easy. If you were buying at 400 and you needed 100 to do the work, they may say, fine, spend 25. You show them proof of what you've done via invoicing, bank statements, whatever, and they will then reimburse you the 25,000 to let you get onto the next stage and so on until it's finished. So it's a useful tool because essentially it means you don't need as much money rather than having to have the whole £100,000 to go and do that refurbish. You can do it at 25. So your kind of cash flow, if it's tight, is better managed that way. Always pros and cons. Realistically, it's usually a little bit more expensive, not crazily, but there are more fees. So every drawdown, there's usually a fee, even if it's only a small admin one. The legals are slightly more in depth. But there is definitely a home for them. I think there is a sweet spot between the two. And again, that's client dependent because it depends on how easily you can access money. You know what I mean? If you're doing a refurb project where it's only, say, 40,000, then normally there's a bit of a discussion there because my gut feel usually would be, actually, I don't think you need the drawdown because what tends to happen, you can get 75% loan to value on the purchase, but that normally gets down to 70. Now 5% alone is probably normally close to that 40 grand. And do you then want to go through the hassle of all of the kind of monitoring? There is more to it. So they will monitor the build, for example. They'll send out an asset manager. They'll do a lot more whilst you're doing your work. Whereas if you just use a normal acquisition or what we call a light refurbished bridge, you're basically left to it. You've got the money, you just get on with it, but you've got to use your own money. So I think it comes down to client specific. And what we would tend to do is if you came and it was maybe in the middle, get terms on both, sit down, work them out. Everything really comes down to the value. It plays a massive, massive role in that. So, if he agrees with your end value, if he doesn't, that can impact the numbers. If he agrees with your cost of works, if he doesn't, that can impact the numbers. So you don't really know where you are until the surveys are all done. By then, you've obviously spent a fair amount of money up front because it's all in valuation. So it very much depends on how much you need. Bigger projects, it's a no-brainer. If you're going to be spending, if I said upwards of 100, it probably does work. 150 upwards, you're doing a big refurb, that'll have a lot of extension work. It will definitely make sense. But you've got to be prepared for the hassle. A lot of people do deem it a hassle. Not everyone, and there are definitely lenders that are better than others.
Yeah. Good. Now we've got new government, Labour government. Interest rate is still high. Yeah. It's coming down, hopefully. There's a lot of changes. So what is your view on
the market? What a question. It's difficult. I think before the Labour government came in, I think that the buy-to-let sector was already struggling. And that's mainly due to the increase in interest rates impacting rental calculations, essentially. So what we then have found is that a lot of landlords have had to take maybe 5-year fixes on rates with very, very big fees. You're paying 3, 4, potentially 5, even all the way up to 7% arrangement fees. Yeah. Which is normally against advice. I understand it. In some scenarios, it may make sense. Some people just don't have the option. They couldn't sell it, and then you're stuck. I think really it still kind of funnels that way in that it's challenging, I think is the way. We're all hopeful rates go down, and I don't think they need to go down by a huge amount to kind of get things moving again. But yeah, it's difficult. I think the way it's going at the moment, it's not easy to save money for a house. So people are going to carry on renting. But then at the moment, it's also not easy to do a buy-to-let. So some will eventually give, but what way, we're not sure. I think certainly from what we see, we're still busy. There are still a lot of inquiries. People still want to own their own homes. So I think the market in general should be okay. But I think there is a kind of change in landscape in buy-to-let. I think, your single property, buying a lot of the time it could be people drawing down on their pensions to buy one buy-to-let to kind of tick them over, that's gone. I don't think that market's really there. I think people with spare money, they're not really getting much of a return now buying a buy-to-let. So until that changes, there's no incentive to do so. And we don't know how long that will take. I think you're right. Interest rates play a massive part, and that's still very much up in the air. They come down even by 1% of that possibly is enough just to get things moving again and the momentum go. Yeah. So tricky.
Is buy-to-let dead?
I've been saying it should be for a couple of years, I think, as you know. Buy-to-let in itself, I don't think it is dead. Like I say, just due to the demand and people need somewhere to live. I mean, this is the thing. I mean, the buy-to-let sector has been really, really hit hard. Certainly by taxation changes, by even EPC regulations. You can go buy any house you want to live in, but if you buy it as a buy-to-let, it's got to fit certain regulations, which doesn't seem fair. Taxation is still the biggest one. If they sell the asset, there's tax. Basically, not a lot of people feel sorry for landlords. I'm aware of that, and I have to be careful what I say there. But at the same time, it is increasingly challenging. So what is the answer? Someone's got to be out buying the property. So, who's going to buy them? And at the moment, rates are still too high for your kind of first-time buyer, next-time buyers to kind of step in and take over, I suppose that buying power that buy-to-let owners had. So I don't know. It's a challenging one. I mean, there's obviously been a lot of momentum to try and kind of squash the market, is my honest assessment of it, and it's worked to a certain extent. But how far do they let that go before, other repercussions start to kick in? That's the key point.
I still do think it works in some parts of the country.
Always.
Northeast, for example. If you get it for the right price, it could still work. And also sometimes, maybe you just rent it out as a serviced accommodation. So much higher.
I think with the renters reform bill and the other bits and pieces coming in, I don't think any of it is actually that bad. I mean, there are bits of it that are slightly more, but I mean, realistically, if you were doing it properly in the first place, it shouldn't impact you as well as others. Serviced accommodation is an interesting one. A lot of buy-to-let lenders don't specifically like it. Some will allow it, some don't really want it. But it's very difficult for them to manage anymore. If you've got to do what you've got to do, I suppose, and that's part of it. I think even then, whether they'd admit it or not, probably prefer someone in there than it be a vacant. Could be in breach of conditions, though, so you've got to be careful. Is it a market that's going anywhere? I don't think so. People still, the demand is still there. I don't know. I think we've got a fairly interesting year or so coming up. Certainly, from my own clients' dealings, people are still buying. It's not totally, people are still buying, but like you say, there's a price point to that now whereas before people were quite flexible. There was a range, and if it worked, they'd buy it. Now they're really looking at as low as possible. And that probably should be how it should be. Like I say, until they kind of solve the problem of who else is going to buy the properties and get things moving, I don't really know how we see movement.
What are the common mistakes people like us, your clients, do when we apply for property development loans or bridging or?
That's a good question. I mean, mistakes-wise, in terms of the client themselves.
And how we can avoid it.
I think.
Or the things that we.
I think the biggest, I suppose, things that impact loans is actually not necessarily the client. It's normally the valuations. And that's not always the valuer's fault. I think I touched upon it earlier. Someone's came to me and they're saying we're going to spend 50,000, but when you get the schedule of works, the surveyor says it's 100. The bank will always trust that surveyor over the client, and that can impact numbers. I think valuations play a part, and there are ways around that. People can do valuation packs, people can do certain things and provide that to the surveyor to try and help him come to a kind of decision that matches what you expect. Doesn't always work, of course it doesn't. But, I think that is it. I think if you've never done it before, of course, it's very difficult to even know about that, and that's where brokers should try and help. Give them as much information as possible. Other than that, not a lot. I mean, for the most part, certainly with bridging finance, it's more on the property itself. And that's the key point. On normal buy-to-let mortgages, assuming no issues with credit, then it really is down to the valuation. Does the rental stack up? Tenant profile, I suppose that could be another one, depending who you've got in there. A lot of people, I do guaranteed let schemes, not knowing that actually their lender wouldn't like that. If they find out, most say high street entities, they won't be happy that you've got a 3-year lease with a provider who's guaranteeing you let every month. So that kind of thing can trip people up. And you wouldn't necessarily know that unless you've read through the terms and conditions of your mortgage, which most people probably wouldn't, is the honest answer. So those kind of things, that would be I can't think of many other things as a client that you would do that would necessarily trip yourself up involuntary.
Okay. And what are the new trends or new financial products coming up in this year or months?
I think in the residential market, which we'll touch on briefly, there are a lot of kind of lifetime mortgages coming out, which we see, I don't know, called Dutch mortgages, or 25-year terms, with a fixed rate throughout that whole term. And we're seeing more innovation around that. In terms of, I suppose, bridging in the more commercial world, we're seeing 80% net now, which didn't exist, a couple of years ago. That's relatively new. We're seeing slowly pricing's coming back in. I think bridging loans are always tricky anyway, because it's never really about the rate in my head. It's about who's actually going to do the job, who's going to get it over the line without causing too many, issues along the way. Obviously, within reason. But we're seeing, 80% net. I'm talking to lenders. Commercial will slowly come back. Commercial and semi-commercial properties, they've had a very rough time again, probably since COVID. The retail sector in general, as we know, has not been easy. So because of that, commercial investment became very difficult. It's coming back, and then, semi-commercial as well. That's actually always been slightly more popular of the two. I just think, look, rate is probably still the key driver here in terms for me of moving. Lenders can only do so much. The way they're regulated, they can't just give money away. So they're kind of hamstrung in the same way as we would be, So I think rates will play a part. There's certain things they can do with criteria. For the most part, as I'm starting with, we can fund most properties. There's always an option, and that's what more can they do? And I look at it, I don't know. Yes, lowering rates will help, but I even think of bridging finance in general. If they drop the rate by even 0.2 a month, does that suddenly mean I'm going to get that many more people coming for it? I don't think it will, because it's only a set group of people that would do it in the first place. So difficult. I think, could you go higher loan to value? You probably could, but that would be very risky on a bridge. It doesn't take much for that loan to go wrong, so I don't think we'll see much there. And other than that, no. I just think, I think trends-wise, HMO conversions have been big for a long time. That's not actually new, but, it's still there. I do a lot of 1 to 2 bed conversions, which bridging finance is perfect for. So could there be specific products for that kind of deal? Maybe. Don't know if it would necessarily mean more work, though. Don't know. But
what are commercial to residential? Because that's the buzzword. For the last few years now, because it's been mentioned a lot.
I think that's it. The PD rights around it meant that people did like it. Although, again, we've dealt with it. I see it, but not as much as you'd expect, because they're actually quite hard to find. And they get treated pretty much the same as a normal refurb deal. So from a finance perspective, providing it's got its planning in place, PD, whatever you're doing with it, then you can fund it in the same way as if you were buying a house to convert it to flats. It's the same, and it will be development finance. You can get on with it. So it's there. There are sometimes, it depends on what the commercial was on. I find a lot of them, sometimes the tenant's still in there and you've got a lease length to wait until they're vacant, etc. There are a few bits there, and that can get more tricky, because then you have to hold it for a prolonged period of time before you then go into development finance, because you can't obviously start doing any work when you've still got a tenant in there. But it's there. It's there. It's definitely still viable. Assuming the right area, costs all make sense. I think that's the other factor. Cost of works these days are, if you look on where they were even 5 years ago, it's a different landscape altogether. And I think that plays a part in commercial to resi, because, a lot of the way offices are obviously built is slightly different, and there is a cost in terms of getting that right. And that's sometimes what we see as the kind of biggest, and people don't necessarily take that on. That's quite a big challenge. If you've never done it before and that's not what you do for a living, you're putting a lot of trust into a contractor there with a lot of money. And a lot of people are put off by that. So, but it's still there, definitely viable if you can find the right site.
And what advice would you give to a first-time property developer or investor?
Again, depends what their objectives are. If we're talking, and I suppose a lot of them are, we're going to try and raise a cash pot. Originally, it isn't necessarily about a yield or a monthly income. I would normally say to stick to smaller stuff. You don't want to go all in, unless it's the deal of the century, which they do come up. But, not very often. But go 1 to 2 beds, start small, do something that's perfectly manageable where, it's not daunting. If you're buying a 3-bed house and converting it to a 6-bed ensuite HMO, and you're doing extension works up, back, that's a lot going on for someone who's never even done anywhere. And, that level of work. 1 to 2 bed conversion, we can, a lot of the work's legal. You need a license to alter, you need them to agree to it. Your solicitor deals with all of that. Let them get on with it. You're paying that. The actual work itself is usually quite easy. You're flipping a kitchen probably from one wall onto the reverse wall, and you've got a new bedroom. It isn't that difficult.
Yeah.
So I'd say start with something like that, or just a general refurb where you don't even have to do that. If you can find one, and again, it just depends on what they want out of it. If it's Nothing better than experience. I think, the more you do, the more you'll eventually save on the next project, etc. So if you found something that's derelict, you can get it for a price. Even if your return isn't massive, as long as there's profit and you've learned, then I would say that's actually still a win. You know what I mean? So yeah, that's the advice. Start relatively small, build it up slowly. And once you've got, and let's be honest, having the money is quite important. If you run out of money on a project, that's the biggest issue always. And then you end up, yes, there's private investors or finding money elsewhere, but that can be expensive. So, start small, kick it in within budget and go there.
Yeah. Great advice. If somebody wants to reach out to you, how do they get hold of you?
Yeah, email, WhatsApp, anything. Details can be shared.
You can share on there.
I'll show them on here. Yeah, no, normally email would be best as an intro. Then we'll schedule, whether it's Zoom call, meeting, whatever they want to do. Just to have a quick chat, get an idea on where they are, what they want to do. We'll take it from there. Yeah.
Perfect. It was great. John, I learned a lot today. Hopefully the viewers will also learn.
Brilliant.
And thank you very much for coming today.
Thanks very much. Thank you.